So my name is Sidi Dasby. I am from Eco Sustainability. As we wait for a few more people to come in, I would like to take this time to get to know the group a little bit more. So hopefully, if you're okay, you could drop a note in the chat to let us know where you're joining from, which industry and which company you're with, even. I can see a few familiar faces in the group right now. So it would be nice for us to get to know each other a little bit more. But for now, allow me to introduce eco-sustainability a bit more with this video. All right, so once again, we are Eco Sustainability. We are a consultancy firm based in Singapore. And while we're based in Singapore, we have a bunch of people all over the region. We have teams on ground in Cambodia, in Indonesia, Malaysia, Thailand. And myself, for example, I am in Manila right now in the Philippines. And we do a range of work with respect to ESG, but mostly covering sustainability reporting, broader consulting work, carbon credits, training, and policy development. And as you can see here, we're in 6 countries, but our work spans even beyond Southeast Asia. We've done work in the Pacific. We've done partnerships in the Western Hemisphere. We have presence also in South Asia with over 100 projects already, 21 consultants, and 17 different standards. I'll elaborate a little bit more on that later on. For now, we have our colleagues right now in this group actually from Thailand. We have somebody from Indonesia and somebody from Malaysia. Again, we're all over the place. So wherever you are, hopefully you could let us know where you're based in the group chat so we could know and we could properly address you as well. So here's what do we do exactly at Eco Sustainability? So a few things, as mentioned earlier, we do green consulting. So this is more on the more practical advice on cutting greenhouse gas emissions, for example. We also do a little bit of a think tank work. So we do research and policy recommendations. We've worked with local governments or government units. We handle carbon credit projects. So we calculate and verify them. We run education and training both on the technical and non-technical side. And of course, we do sustainability reporting itself, and we help companies put together reports and actually meet regulatory standards and stakeholder expectations. So, as mentioned earlier, we said that we have 17 standards. So what does that mean exactly? It means that we work across pretty much every major standard out there. That covers everything from ESG disclosure to greenhouse gas reporting, carbon neutrality, and product carbon footprints, including assurance work. I won't take the time to read out loud everything that's on this slide, but what you need to know is whatever framework that your regulator or your investor is asking for, chances are we've done some work on it as well. But this is something that if we're more proud of. You'll notice that we say that we are standards contributor. What does that mean? It means that in the world of this the in this universe we have the standard setters. We have the big organizations like the ones pictured here, like ISSB, SASB, the GHG protocol, Vera, etc. They write the rules. And then you have the users, companies, consultancies who need to prepare the reports, the auditors, the regulators who rely on these standards to follow them and make the reports accordingly. So apart from that, we also sit in a smaller group that's a little bit in between. We are what we call standards contributors, which means that we give technical input directly to the standard setters. We help shape and improve the rules themselves through exposure drafts and technical consultations. So we're not just doing or applying the standards from the sidelines. We're also helping build them based on the real on-ground work that we do with partners and clients. So just a little bit of housekeeping. This session is being recorded, and if you need to revisit anything later, we will be uploading this in our YouTube account. So we would like to ask everybody to keep their microphones muted while I'm presenting, just so the audio is clean for everybody. And if anything comes up, feel free to type it in the chat. My team will be jumping in, and then we'll help answer the questions in the chat. So no stupid questions in this room. Feel free to ask anything that you need. So in terms of our intended outcomes, here's what you should walk away with by the end of our time together. First, a solid and plain language understanding of the ISSB framework. No jargon overload. And I promise the hope here is to shift in how you see sustainability reporting altogether. That it's not just something that, you tick boxes like an exercise, but it's actually a very useful strategic tool for your businesses. The practical first steps to actually start your own report, even if you're running a small business or a bigger business, for example. We hope to give you enough confidence to talk about sustainability with your management, your auditors, your banks, your clients, your investors. And we also want to help you create a clear line between sustainability disclosure and what it means for your business, your long-term value, your risk management, and your access to capital. So, with respect to the broader ESG or sustainability landscape, a lot of countries have moved and are currently moving from voluntary to mandatory reporting. So let's set the stage, right? Not too long ago, sustainability reporting was voluntary, meaning it was nice to have. Mostly for companies, they did it to look good, but they kind of were just using whichever standards they feel like they could understand better, right? But it's shifting very fast. In the Philippines alone, there's an SEC memo which would require publicly listed companies to come up with their first report next year. And I'm pretty sure that that's going to be the trend all over the region and beyond. So, what is and what isn't sustainability reporting? So, a lot of people walk in and assume that sustainability reporting is mostly talking about, like simple things like what trees we planted, etc. But actually, there's a broader reason why companies start doing sustainability reporting. So, where does it start? Most people, they begin with environmental data. That's what we understand sustainability reporting to be. We look at electricity bills, fuel consumption, water usage, etc. And then it grows into a broader understanding of how these things add up with respect to your investor and stakeholder transparency, risk management, and business resilience, etc. So there's a lot of data to be had here, and there's a lot of work to do in order to come up with a sustainability report. And as mentioned earlier, in the past years, a lot of bigger companies would do this because it makes them look good or because it helps appease their investors. But really, the bigger part of this is trust. Reporting shows your investors, your customers, and your employees that your business is well managed and that you're thinking long term. It also sharpens your risk management. It helps you spot supply chain issues or regulatory changes before they turn costly. And often, the process itself uncovers efficiencies. Once you start measuring energy, water, or waste, you tend to find savings that you didn't know existed. And on top of that, lenders and customers are increasingly looking at your sustainability performance before they even engage with you. So, reporting here can actually open doors for you to financing, to tenders, to new markets. So, companies don't just need to do this for compliance, they do this because it makes them more resilient and it makes them more competitive. So, here, we're looking at the reporting maze, and I know that this slide can look a little bit overwhelming. And honestly, for a lot of companies, that's probably how they feel. There's a lot of frameworks and guidelines out there, but the truth is, a lot of them aren't exactly fully aligned with each other. So, for a lot of companies, the dilemma was, where do we start? Which framework actually matters, and which one do investors pay attention to? A lot of companies, they want to do reporting, but the landscape was super fragmented that it felt like a maze that was very difficult to get through. So let's just look at the evolution of reporting standards. So let me quickly walk you through how we got here. So TCFD here focus specifically on climate-related financial disclosures. And then we go to CDSB, which handled environmental disclosure in a way that aligned with financial reporting. And then SASB here gave us sector-specific sustainability metrics. GRI took a broader stakeholder-based approach, um, and CDP focused on companies disclosing their carbon emissions and environmental data. TPT, the Transition Plan Task Force, helped companies build credible transition plans toward net zero. And integrated reporting connects financial and non-financial information into one holistic report about how company creates long-term value. Each of these standards, each of these institutions, they did valuable work on their own. But again, lots of words. I said a lot of big words, and they weren't speaking exactly the same language. But now we have the IFRS Foundation here. So this is the IFRS Foundation. It might be familiar for some of you if you've dealt with financial reporting before. So they were setting the global accounting standards through the IASB since 2001. And then in 2021, they expanded into sustainability with the ISSB to meet the growing climate and ESG demands of today, but under the same trusted global structure. So what that tells you is sustainability reporting is no longer a separate and softer discipline. It is being standardized the same way financial reporting has been for decades. And that also means that the demand for sustainability professionals is only going up with the expectations placed on them. Sustainability is now not just a nice to have, it's officially a boardroom conversation. And then we look at the global baseline. So we have ISSB. Basically, they set the standards floor, and they gave us the comprehensive foundation for disclosure that works across different jurisdictions, a common language for comparable, decision-useful information that meets what investors need across global capital markets. Countries can always build additional requirements on top of their own local needs, but everyone needs to start from the same solid base. So we look closely to the ISSB objectives. What is ISSB exactly, and what are they trying to achieve? A few things. They want to develop a global baseline for sustainability disclosures, meeting the information needs of investors, helping companies present comprehensive sustainability information to global capital markets, and making sure all of this works smoothly alongside jurisdiction-specific or broader stakeholder requirements. Now, here's a simple way to picture that last point that I mentioned. A company discloses under the ISSB Global Baseline, for example. Say Malaysia, they require a few extra local disclosures, some social issues specific to their market. Now, because ISSB is built for interoperability, that company can just build on top of what they've already disclosed rather than starting from zero, which saves them real time and cost and, mitigates any confusion. So let's look at the ISSB adoption around the world. As mentioned earlier, this industry is really only just growing, and the ISSB adoption growth is happening at real scale, and we can see it right now. More than half of the global GDP is either already reporting under ISSB or actively moving that way. So this gives us a pretty clear picture. This isn't just another framework to add to the pile of our already piled up work. It's becoming a global reporting language with regulators, investors, and capital markets all pushing towards one consistent baseline. So when we say that we're ready to start reporting under ISSB, we're aligning with where the world is already heading. Okay, so I was just reading the chat. Again, feel free to drop your questions if you have any. So let's look at materiality. Before we get into the structure of ISSB standards, I want to talk about what materiality means, because this is one word that would come up consistently in sustainability reporting. And of course, it's worth to take some time to understand it better. Not every ESG topic matters equally to every business. Under ISSB, something becomes material when it can reasonably affect your company's future cash flows, your access to finance, or your cost of capital. We'll circle back to this idea shortly because it really helps direct how we'll approach reporting. So what's the core structure of ISSB standards? Let's get practical. ISSB standards is built across or around four pillars. We have governance, strategy, risk management, and targets. These come from the IFRS S1, which covers general sustainability disclosure, and S2 covers the one specific to climate. Now think of these pillars as the backbone of sustainability reports. Everything else will flow from here. Together, they'll tell us the sustainability story of your company, who's overseeing it, how it connects to your business model, how risks get managed, and how progress actually gets measured. And this is worth remembering because investors don't just want to know what you're doing. They also want to see how well you're managing the risks and opportunities across your entire business. So, um, again, structure is one thing, but why does the four ISSB pillars, why does it matter to your business? Okay, hold on. Let's look at each pillar first. Let's start with the first pillar, governance. Simply put, this is about who's actually driving sustainability on top of your company. So a good example here would be Eco World on the right part of the screen, as you can see. A property developer in Malaysia. Their board doesn't just rubber stamp policies, they actively try to review sustainability performance, they factor climate risk into their decisions, and they approve ESG targets. They've built a clear three-tier structure: the board, a sustainability committee, and an ESG working group. So sustainability is embedded in the business rather than sitting off to one side. So what does that tell investors? It tells the investors that this company takes sustainability seriously with clear accountability running through every level. And that's exactly why ISSB starts with governance, because with proper oversight, the data underneath, they don't really carry much credibility until we know how everything is managed. Which means we move to pillar two, which is strategy. How do we connect sustainability to business goals? So Nestle here is a very good case study. They haven't just reduced the environmental footprint to, as a sort of checkbox to report, right? They've also built sustainability directly into their sourcing, their manufacturing, and their packaging decisions as part of a net zero roadmap from 2018 to 2050. With clear milestones along the way, a 20% emissions reduction by 2025, 50% by 2030, and net zero by 2050. Now, once you embed sustainability like that, something will shift. It starts generating real value. It helps manage risks. It drives innovation. And it keeps the company ahead of competitors. Under ISSB, companies need to explain exactly how sustainability risks and opportunities shape their business model and future profitability. Nestle's roadmap here is a solid example of what that could look like in practice. Now let's go to pillar three, which is risk management. How do we identify and manage sustainability risks? So this is about how well a company prepares for things before it comes, right? So Singtel, for example, is a telco based in Singapore. Their risk process isn't a one-off audit. It's a continuous cycle of identification, analysis, evaluation, and treatment with a continuous and ongoing monitoring, review, and consultation built in. This is not ad hoc. It's not reactionary. It's a repeatable system that closes the loop with formal recording and reporting. This is the kind of structure that shows risk management isn't just about compliance, it's about staying a step ahead and turning risk into an opportunity for long-term growth when it's done well. Now, let's go to the last pillar, which is metrics and targets. How do we measure what matters? This is where sustainability gets quantified, right? We talk about time-bound targets, consistent tracking, etc. Nestle Pakistan is a good example here. They are committed to making 100% of their packaging recyclable or reusable by 2025, alongside a 20% emissions cut by 2025 and net zero by 2050. Now, what matters here isn't that the numbers are big and ambitious, but that they're consistent in tracking and reporting and communicating their progress. So that means their reports are auditable, comparable, and it's very useful for decision making. So let's look at sustainability related financial disclosure. What does ISSB really mean? So again, sustainability issues become financially material for sustainability issues for ISSB need to be financially material. What does that mean? If a sustainability issue can move your revenue, your costs, your assets, your cash flow, or your risk profile, it becomes financially material. And once something becomes financially material, it needs to be disclosed. That's the exact phrase that ISSB uses, sustainability related financial disclosure. What that means practically is you're expected to explain three things: what sustainability risks and opportunities your company faces, how they could affect your financial position going forward, and how your management is actually responding through strategy, risk management, and targets. Climate change, resource scarcity, labor issues, supply chain disruption, these would get treated the same way financial risks like interest or currency risk always have. No longer soft topics, no longer nice to haves. Again, these are decision useful data points. So let's look at a mini case study. We have here the coffee importer. They have usually like physical risks, right? So heavier, more frequent rains in Guatemala are disrupting harvests, and supply becomes less predictable because of the weather. So farmers will face losses, and the importers end up paying roughly 10% more for beans every rain season. Now, from an ISSB lens, this isn't just a simple environmental story. It hits a very direct financial cost. The cost of goods sold will go up, margins get squeezed, and earnings become more volatile because prices swing seasonally. Under sustainability related financial disclosure, this company would need to explain the climate risk it's exposed to, how it affects procurement costs and margins, and what management is doing to manage the risk going forward. Now let's look at another case study, a courier company. Now, flooding causes a backlog at their warehouse. Parcels can't move on anytime. Deliveries will get delayed and clients will start applying penalties. And some customers might even switch to more reliable providers. Financially, that's an immediate revenue hit from penalties to lost contracts, higher costs to overtimes, rerouting, and longer term reputational damage that can affect future businesses. Under ISSB, this is the kind of exposure that needs to be disclosed because it directly touches cash flow, cost structure, and risk profile. So, we've been talking a lot. How do we get started with sustainability reporting exactly? I know that for a lot of companies, the hardest part is really just figuring out where to start. So, here's a simple way to think about it as an ongoing cycle, not just like a one-time report that you have to make an ad hoc team for and they have to write 100 pages, right? We have to start with the business context that we already understand, and we work out what's material, we map out our data, set the baseline, and build a roadmap, set targets, and we improve from there. And I really want to put emphasis on this. Sustainability reporting is a journey. It's not a one-time project that we do, right? It's about progress. It's not about perfection. And each cycle that we do reporting, hopefully it sharpens insights and builds more value for your business. And you can even like easily reference reports that you built already, right? So you really just have to start to get started, and then it will get easier as you go on. So with that, we go to the golden rules before you start. Before you actually jump into the reporting process, we have three principles here that we want you to keep in mind to make things easier for you. Number one, start with data that you already have, your electricity bills, HR records, fuel receipts, vendor information. That's probably enough to get going, honestly. And we don't need to aim for perfection in year one. Your first report will definitely have gaps, and that's okay. Starting matters more than getting it flawless. And remember, sustainability reporting is a team effort. So finance, HR, operations, procurement, everyone has a role and you're expected to bring them in. The smoother this go. The more people that participate, the smoother this will go for your company. Second, first step, we have to understand the business context. So we really can't put together a meaningful report unless we have an understanding of how your business creates value and where it's exposed. So that's why ISSB always starts with your business model and value chain. Because risks and opportunities look completely different depending on who you are. A factory, a retailer, a bank, a logistics company, they will all need to do reporting, but they will all be coming from a different context. For instance, a stationery shop might focus mainly on waste and electricity use, while a logistics firm would look more at fuel consumption and fleet efficiency. So we have to start by mapping your operations, where you operate, who your customers and suppliers are, and what external pressures you're facing, whether that's regulation, customer expectations, or investor interest. Once that's clear, everything else in your report will start to make more sense. Step two, we identify material issues. Once you've mapped your operations, the next move is to focus, and that's where we kind of identify where materiality comes in. Not everything, again, matters equally to your business. Again, under ISSB, An issue is material if it can reasonably affect your cash flows, your access to finance, or your access or cost of capital. So the real question isn't like what's good to report or what looks good to report. It's what could actually move my financial performance or risk profile. Ask yourself which ESG topics could seriously affect your business success or reputation, and what your customers, investors, or regulators actually care about. For a property developer, that might be materials sourcing and safety. For a food manufacturer, it could be energy, waste, and product safety. What comes out of that exercise will be your focus. Step 3 is to map your current practices and data availability. So step 3 here, you need to map what you're already doing and what data you already have, even if it's incomplete. Most businesses have more data sitting around than they realize, and finance records, HR systems, procurement files, facilities data, operation reports. So for example, right, a tech firm here, they might realize that they already track employee computing data through payroll addresses, and they have energy bills enough for each office floor, but they just don't happen to centralize these records. So they kind of waste the collection that they do. So whatever gap that you build now, that's a gap to close next year, but not a reason to stall your reporting. You don't need to reinvent the wheel every year. Start with again with what you have, spot the gaps, and assign clear ownership. Step 4, we collect your baseline data. This is your starting point. It answers the question that your board will inevitably ask, which is where are we today and how do we know if we're improving? Without the baseline, targets don't really carry credibility. And without credibility, you can't really share progress meaningfully. Practically, this could be that your electricity bills for energy, invoices from waste collectors for staff mileage claims, or flight bookings for travel, and supplier invoices, especially for packaging or raw materials for procurement. Start simple. Your monthly electricity, water, or fuel is probably enough to begin with, and you don't have to stress about precision at this stage. Consistency matters far more. And we go to step 5, we have to build internal capacity. Sustainability reporting is never a one-person job. As mentioned, finance can help pull the data, HR can track your social indicators, operations knows what's actually happening on ground. And even a small business can make real progress here. One local retailer formed a 3% sustainability committee. HR can handle the data, admin can cover utilities, and the owner is setting overall strategy. At the end of the day, this isn't just about collecting data anymore. It's about governance and accountability. Now, step 6, we build your sustainability roadmap. This is where you turn your data into an actual plan, phased and realistic enough that you can execute it. A manufacturing SME, for example, might set year 1 as a tracking energy and as a year to track energy and waste, year 2 as to reduce waste by 10%, and year 3 to install solar panels. Start small. Maybe that's switching to LED, for example, instead of like completely doing something big every single year, and build up towards your goal over time. A clear and simple timeline makes sustainability feel like it's part of your everyday planning and not just something abstract. And of course, step 7, we have to set simple KPIs and targets because we can't really control, what we don't measure. So once your roadmap's in place, we need to translate these goals into something measurable, specific, and time bound. For example, a printing shop might target paper waste to reduce paper wastage by 10% in the following year, or get to 100% LED lighting across all outlets by 2026. So you have to start with something achievable, a cut in electricity use, an increase in recycling, and then you widen your KPIs to cover other social and governance areas as your data matures. And then again, just to emphasize, step 8, start small, iterate, and improve. ISSB itself is built around continuous improvement, so you don't have to wait before you have everything figured out. Plenty of SMEs started with a one-page sustainability report, and within 2 to 3 years, they grew into a full ISSB aligned disclosure. Again, your first report, it doesn't need to be perfect, it just needs to exist. And each cycle, your data gets sharper, your story gets clearer, and your team becomes more invested. Companies that start early tend to get better access to capital, stronger customer trust, and more resilience when regulatory or climate shocks hit. So, what are the common challenges that you could expect to encounter, and how do we overcome them? Of course, every company would hit a few bumps along the way, and that's completely normal. So, for example, data might be scattered, resources might be tight, and management buy-in might still be a work in progress. But if data is the issue, for example, and you just start with what's available, right? And assign one data champion per department, somebody to collate the receipts, somebody to hold people accountable to report their consumption. If sustainability knowledge is limited, for example, there are a lot of free webinars, much like this one, and you can appoint an internal ESG lead to help you coordinate things. And if time and resources would be your primary constraints, you can weave sustainability into what's already running. So, for example, HR can track training hours, and then finance can already track energy bills, right? These things you already do. You just have to be aware of them. And if buy-in from management is the difficult part, then maybe you could start by giving them a quick, visible win. Even something as simple as showing reduced electricity costs can build momentum. Most SMEs have their data, again, it's just scattered across different places. And as we are emphasizing, it doesn't need to be perfect from day one. So let's look at what good sustainability reporting looks like. How do you know if your report is actually good? Honestly, it's not about being polished or perfect. It's about being credible, consistent, and useful for decision making. Strong reports have clear KPIs, disclosed risks and opportunities, they have targets with real timelines, and they're clearly explained data sources. Weak reports tend to share a few traits. Usually, they have generic statements, they don't have any real numbers to back it up, no risk disclosures, no accountability. So, a good report is built on transparency and truth, and it's focused on improvement. It doesn't concern itself with being too glossy. Investors, banks, and regulators can tell the difference pretty quickly. So, companies that provide credible data tend to stay in the value chain. And the ones that can't often face higher financing costs or they get left out. So, how do we bring everything together? From reporting to value creation. Once you've started, the journey doesn't really stop here. Sustainability reporting grows and matures alongside your business. The key is to weaving it into your strategy rather than treating it as a yearly checklist. The more that you refine it, the stronger your resilience and credibility becomes. Companies that start early tend to learn faster, attract better partners, and unlock more long term value. That's really how reporting moves from compliance into value creation. At this point, sustainability reporting is not about reputation anymore. It's about resilience, access to capital, and long term value for your business. And with that, we end our talk. That's everything that we wanted to say this morning. And I'd love to open up the floor for any questions. You can unmute if you want, but you can also just chat it in the chat box, and my colleagues will help answer. Um, and before you can ask them now. Okay, Krishnan here says financial impact is both favorable as well as adverse. Yes, that's correct. So again, what matters here is transparency, right? And making yourself accountable to your investors and to your partners. The slides will not be shared. However, we do upload our talks on YouTube. And we will be sharing it in the WhatsApp group after this. Any other questions? All right, if you have no more questions, we do have talks every Monday. So this is us right now, August 24. Next year we have my colleague from Thailand, Charin, who'll be talking about sustainability as a driver of business advantage. And then just you can look at our WhatsApp and our LinkedIn for the series of talks that we'll be having. But just to let everybody know, these are our contact people. If you have any more questions, feel free to message us. Charian is from Thailand. I'm from the Philippines. Henry and Ariel are from Indonesia, and Tanglo, I believe, is from Malaysia. So with that, again, do you have any more questions? Okay, so WhatsApp group is this one. You can feel free to scan the QR, and there's also the link shared by my colleague. All right, going once, going twice. If there's nothing else, Again, here at Eco Sustainability, we want to build a world where every company is a sustainability superstar, and we hope to stay in touch with everyone. Feel free to reach out anytime. Thank you so much.